continue with forms of businesses. So today we're going to go into limited companies. Why do we call them limited companies? We call them limited companies because, we call them limited companies because they have a separate legal identity. And when we talk about having separate legal identity, it simply means the owners can be separated from the business itself. So that means whatever happens to the business, it does not affect the personal wealth of the owners. That's why it's called limited company. You get the point here? We call them limited companies. They are not sole traders, they are not partnership. For sole traders and partnership, they are on limited liability, which means you cannot literally separate the owners from the business. So whatever happens to the business affects the owners of the business. These are unlimited liability. So you cannot separate them. But when it comes to a limited company, for a limited company, whatever happens to that business, it does not affect the personal wealth of the owners. That's why it is a limited company. So I wrote, a limited company has a separate legal identity. This implies that the owners do have limited liability. So the only thing they're going to lose is the investment they have. Aside that, it's not going to affect them, their personal wealth. It's not going to affect them. So limited liability, which means that the owners can only lose their investment, but not their personal wealth. In the event that the business is unable to pay its debts. So the business might have debts, and if it's unable to pay it, the owners would not be affected when it comes to their own personal things. That is what it means. So what are the features of limited companies? The first one, they raise capital through the sales of shares. So because they are limited companies, it means they have to sell shares to raise capital. It's not just you putting money into it like a sole trader, or you coming together to put money into a business like partnership. Here, if you have to start the business, you have to sell shares. You can't just start it by putting money. You have to sell shares. Do you understand shares here? So they raise capital through the sales of shares. So whatever amount of money they use for the investment, it has to be through share issue. The second one, owners have limited liability, which means the owners are separated from the business. Whatever happens to the business will not affect the owners. The third one, they are run by directors who are elected by shareholders. So we have different types of shareholders. We have ordinary shareholders and preference shareholders. So those that make appointment, those that elect the directors are the ordinary shareholders. The ordinary shareholders are the ones in charge because they have the business. They are the ones that they elect the directors during the annual general meeting, AGM. They elect the directors during the AGM, and they pay corporation tax, unlike sole traders and partnership. For sole traders and partnership, they pay income tax like individuals or salary that will pay. But for limited companies, they pay corporation tax, which is taxes on profits. So these are the features of a limited company. So then how do we form a limited company? To form a limited company, it means the business has to come up with two documents which has to be tendered to the registrar of companies. And they are article of association and memorandum of association. We have the MOA and the AOA. The MOA and the AOA has to go through the registrar of companies. And as soon as the registrar of companies finds it that it is authentic, then there will be authorization. Then the company will be issued a certificate of incorporation. Get the point here? The business is already setting up. So as soon as the business wants to set up, the first thing the business has to put together is the document, which is AOA and MOA. These documents will be sent to the ministry, which is the head of registrar for companies. As soon as the registrar of companies finds it and scrutinize it, finds it authentic, then the head of the registrar will endorse it and issue a certificate of incorporation. So the certificate of incorporation is what the business will use in starting up the organization. So what do we use the MOA? I wrote MOA. This is a document that sets out the constitution and details of the company. So when we talk about constitution, here we're talking about the rules, the policy guiding the business. Constitutions are the rules, the policies that guides the business. It will be written in the MOA. The name of the company, it has to be part of the memorandum of association. The name and address of the company's registered office, where the head office is, or the head office is in Tripoli, or the head office is in Misrata, wherever it is has to be stated. The third one, objective and the activities of the business. So what's the objective of the business, and what kind of activities does the business encounter or do? And the last one, the amount of capital raised and the share issued. So here, like I told you earlier, they sell shares to raise capital. So which means the registrar would have understand the amount of money made through the sales of shares. So it has to be stated, and when the registrar has to see it before they give the endorsement. Then we have the article of association. For the AOA, this document deals with the internal affairs of the business. The MOA is external, what happens in the business, which can be known to everyone. But for the AOA, it's all about the internal affairs of the company. And there's one thing I did not write here, which is the profile of the directors. It has to be stated in the AOA too, the profile of the directors. Let me just find the way, the profile of directors. It has to be part of your AOA. So what are those items in the AOA? Number one, rights of shareholders. So because we have ordinary shareholders, we have private shareholders. And the difference between an ordinary shareholder, stop writing please. The difference between an ordinary shareholder and a private shareholder is this. An ordinary shareholder owns the business, owns the company. So they don't have fixed rate of dividends, unlike private shareholders. For private shareholders, they are just investors. So they have fixed rate of interest. That's the difference between ordinary shareholders and private shareholders. For private shareholders, again, they do not elect the directors, while ordinary shareholders are part of those that will elect the directors. Are you guys getting what I'm saying here? We have ordinary shareholders, who simply means these are the owners of the business. And we have preference shareholders, which can be you and me. We buy shares, that's all. So the interest is we're making investment and we are finding a share of profit. But for ordinary shareholders, they are literally the owners of the business. They don't have fixed rate of interest or rate of dividends. So if they have to elect directors, it has to be done through the ordinary shareholders. The private shareholders, just like those that have debentures, they are not part of those that elect the directors. Do we get the difference between an ordinary shareholder and a private shareholder now? We call them ordinary shareholders because they are part of the organization. They are the owners of the business. But for private shareholders, they are not. They only have investments, which is the bought shares. So, and they don't take part in the election process. So that's about the rights of issues. The second one is the procedures for appointing directors. Mostly they appoint their directors during the AGM, the annual general meeting. That's when they appoint their directors. But whatever procedure they have to use, it has to be stated in the AOA because the AOA is part of the internal affairs of the business. The third one, duration on the tenure of the directors. Oh, the director is going to spend, the managing director here, it's going to spend 3 years, it's going to spend 4 years. It has to be stated in the AOA. The next one is time and frequency of companies' meetings. So when, we're going to have our annual general meeting at the end of the year, maybe December, or we have 2 meetings within the year, maybe May and December. It has to be stated in the internal affairs, which is the AOA. And the last one, arrangement of auditing the company. When we talk about auditing simply means checking the facts and the figures, comparing the company's figures with what is written or what is stated in the computer or in their document or in their data. So that is auditing. Every company has to be audited and it has to be stated in the internal affairs. Do you understand AOA and MOA here? For MOA, these are external affairs of the business which has to be known to the registrar. And for AOA, these are internal affairs of the business which also has to be known to the registrar. As soon as both are endorsed and are attested okay, then the company, the register of company will issue what we call certificate of incorporation. So then the business can commence as a limited company. Is it clear? Any question, please? No. Thank you.